Hi everyone, in this video I want to do a quick run through of Adobe. So Adobe is currently have a market cap of 136 billion, a PE of 28, which we will go into whether that is justified. It's relatively high compared to the market, but we'll see that in a second. So in the last year or so, Adobe has fallen 57%. Over the last 5 years, it is at 92%. Increase. So let's dive into it. Let's see the sort of basic fundamentals. Let's have a look at their last quarterly report and sort of judge whether we think this is good value. So the highlight of why Adobe has fallen so much is obviously the big acquisition of Figma. I'll leave a link below. Joseph Carlson did a great video on why he believes and why I sort of share his opinion on this, why Figma isn't too bad. Essentially, they're buying out their biggest competitor. It would cost way too much to compete with them, and the users generally like Figma already, so it'll be hard to pull them away. The CEO of Figma seems like a great sort of mind within this space, so I think the sort of incentives to keep him within the business could be good going forward. Someone with a sort of fresh perspective and a sort of challenging the way Adobe is sort of operate their business. So let's just have a look at their financial results. So a 13% year-over-year growth rate, 15% in constant currency. They've had cash flows of operations of 1.7 billion just for this last year. Remaining performance obligations, so sort of locked in revenue under their contracts, is 14 billion. So that's sort of secure revenue coming up. And they purchased around 5.1 million shares. So what this is saying is they've sort of had great annual recurring revenue. They've since they transitioned in the last sort of decade towards a more subscription cloud-based model, they're able to continually grow their revenue by locking in users to their ecosystem, which is a sort of poor word, but they're sort of Adobe Creative Cloud and now Figma, which is sort of expected to add about 400 million next year. So it locks them in. They can gradually increase prices year over year on new subscriptions, so sort of just put the money up in line or greater than inflation, given their strong market position. So as expected, as a cloud business, Adobe has excellent gross margins, 87%, net profit margin of 28%. That is a solid business. They take a lot of money uh, from the customer. Costs them barely anything to deliver that. So for every pound or dollar, it only costs them 13p to deliver it. So that's renting the servers, looking after the sort of ongoing core aspect of their business, contributes to that such a good gross margin. Let's look at their past performance. So we see here, since they've gone to a sort of revenue subscription model, it is a smooth increase year over year. COVID sort of had a brief knock on, as we can see on this period, and then it's sort of slowly tapering off, but the growth rate is still really good. So their cash flow from operations a bit higher, given that they're sort of a tech company. They offer a lot of share-based compensation, which sort of contributes to the difference of the earnings being below the free cash flow. So the actual free cash flow yield is a lot higher in free cash flow margin, I should say, is a lot higher than the earnings margin shown there. Financial health, we can see that they have had debt in the past, which is not increased at all. They now are in a net cash position, so financially very secure. So their debt there is 4 billion, and we can see each year that they're having over, well, this last year 7 billion in free cash flow, so they could instantly pay off their debt within less than a year. Let's look at their sort of financial quality metrics here. So return on equity, 33%, skewed a little bit by the increase in debt there. And when they repurchase shares, that increases the return on equity. So looking at the actual sort of core assets of the business, what are they producing? What's the capital producing? So return on assets, 18.4%, very good, higher than the industry. And return on capital, 31%. So that is absolutely exceptional. We can see that that's increased since 3 years ago, which was 24.7. So we can see that here. So what that's saying is, not only are they getting more capital back, so they're increasing their earnings, they're actually getting higher returns on that. And that's likely because the business doesn't require incremental capital, especially as it's a cloud business. It doesn't require more capital to get the same subscriptions. You're just licensing out software. There's no sort of reproduction costs on that. So we should expect to see the gross margin increase year over year. So let's look at that gross margin. Let's go over to macro trends and see what that has trended so in the last sort of couple of years. Okay, so let's look at macro trends here. An excellent website for looking at the sort of history, especially of US listed companies over the years. So we can see here, this is the revenue for Adobe. So quarterly in the middle, the growth rate here in the bottom. So we can see that's been green for the last couple of years, which we'll go through in a second. And at the top, the trailing 12 months. So we can see sort of early sort of 2010s, the sort of early part of last decade, the revenue was not going anywhere. That was because they were selling you a sort of CD or like a package, a digital download of that version of the software. So you get version 1, that's yours forever. You pay £100 for it, you keep it for as long as you can. They then sort of mid last decade, they then transitioned to a subscription model. So you have to continuously keep paying for the subscription as you do Netflix, as your Amazon Prime. So you only get the access to the software once the subscription is being paid. That gives them powerful lock-in features, keeps people coming back, keeps them using Adobe software, and allows them to sort of continually get the sort of highest update release of the product, but continually paying at the same time. And we can see that reflect in this astronomical increase in revenue. People locked in, paying more and more every year, as they put the price up, as more people join, as they sort of get a larger bundle. So if you think about enterprises, they might have like a certain amount of credits. So more people within the organization are going to their advertising segment, their digital segment, or their document management segment. Let's go to margins. So what have we seen over the last decade? Let's say since they implemented their new strategy of going monthly subscription, SaaS sort of model, margins have just gone up. So gross margin 85%, all the way up to 87% now. Net margin, which is the biggest sort of take-home pay at the end, which is the one you really want to see increase, 7% initially, sort of 5.97 there, all the way up to 28. That is astronomical. That is incredible net margins. It shows their competitive position, and I believe them buying Figma will help solidify their market position going forward. So now let's just go on to ROIC, get a history of the fundamentals on the sort of value line looking graph. So on ROIC here, we can see that they've got a PE slightly higher than the S&P currently, 1.62. Forward PE, given their increase in earnings, expected to be around 21. I'd take that with a pinch of salt. Earnings are only forecasted, it's not locked in. So let's see what the company has been doing. We can see the operating margin, as we saw at Macro Trends, increasing 26.1 there, 35 below. ROIC 25.4 here, and it started out around 10. So this strategy is clearly increasing their sort of efficiency of their capital used in the business. Shares outstanding 473 there, up down from 497. So they've done minor share buybacks. I can imagine that'll escalate in the future. I can't see them deploying their continuous earnings growth into more productive assets. So I think share buybacks is definitely one way for them to go. And finally, let's look at long-term debt. So as we saw, they increased their debt, but it's just been slowly going down year over year. So 4.6 billion there, down to 4 billion. So now let's have a look at discounted cash flow. And let's see what we should be paying for this. So I've spoke about this company in very positive light here. Some people might not like the Figma acquisition, but I think given their sort of reliable revenue stream, it's definitely one to be looking into further. I recommend reading the annual reports, making your own decisions, but let's go to DCF or discounted cash flow, see what we should pay for it. So as part of this DCF here on Excel, it's a very, very basic version of this. This is just giving you a finger in the air rough guide. You shouldn't have to know someone's weight to tell them they're too fat, basically. So it's just a rough guide. So let's run through this. Growth rate next 1 to 3 years around 11%. I've issued it. I think they're currently going about 14 annually, so I can imagine that'll taper off again. 9% 4 to 6 years, down to 7% after 7 in the 7 to 10 year range. Again, these are not going to be correct, are they? They're likely to change. They could go higher, could go lower, but for me, this is a reasonable forecast. Conservatively guessed what their growth rate could be. Discount rate 10%. So that is currently higher than the UK bonds, which have absolutely tanked, and the US government bonds as well. Terminal value, I put 15. So Adobe, another competitor could come up. I can imagine the software doesn't take too much to create this compared to sort of really intricate AI. So I believe that Adobe does have some sort of competitors that could come and take their sort of core market, but given the acquisition of Figma, I think that solidifies them a little bit more. So entering their free cash flow and excess cash here, we can see I've done that. So given this, the current price is $293 a share, and I believe around $326 per share gives you around about a 10% return. Currently, Adobe is good value. I think given their high ROIC, their sort of share buybacks that will help increase shareholder value, but I don't think you're getting it at an amazing bargain price at the moment. We can see here a 5-star price for me would be around 163, 3-star around 228. So that's just, a 5-star price. It would be 50% of what you've intrinsically valued the business. So for me, Adobe is a great business. Prices what you pay, values what you get. There's a reason Ferraris cost more than Fords. This will quote some Terry Smith, but basically, it's a great business, but whether it's at the right value, that's up for you to decide. So please let me know if there's any companies you would like me to look at. Thank you very much.